Thank you, and welcome everyone to today's webinar on the Inflation Reduction Act, what's new and why it matters. We've got a whole bunch of material to cover. Looking at the attendee list, we've got a really broad audience, so really looking forward to addressing a lot of different points, again, in a very brief amount of time. But we really appreciate you taking the time out of your busy schedules to join us and have this conversation in a bit of a roundtable format about the IRA and the latest and greatest relative to this transitory piece of legislation. So quick snapshot of Baker Tilly. We're a top 10 accounting and professional services firm. Been around nearly 100 years now, 70 plus offices across the country, north of 6,700 folks and north of 600 partners now. So it's been a real pleasure to be a part of the renewable sector really for the past 20 years, and our firm really has been embedded in it going back to concerted efforts around, for those of you that remember, the 1603 grant period under former President Obama, and a lot of what we've prepared and how we've organized around serving our clients and the market goes back there and prior to that period of time. So, this is like nothing we've ever seen. There's a lot of new, and as you'll learn today, changing information as we speak, as we go through this evolution and climate transition. But we feel like we've got a lot of kind of institutional knowledge and experience as it relates to a lot of the legislation that's steeped in prior rules, guidance, legislation, et cetera, et cetera. So that's a little bit about us. Let's get right into it here. We're going to talk about the Act overall and then kind of the three pillars of maximizing value to your organization under the Act, and that's prevailing wage and apprenticeship, domestic content, and the energy community provisions. And hopefully, if we have time, we'll get into some examples and have time for a few questions. Without further ado, we'll dive right in. I'll turn it over to Corey Wendt to go through some basics on the IRA, and we'll get right to it. Corey?
IRA is very broad, and relative to the Obama era tax credits that covered some areas, this legislation has over 70 different energy types. So if you take a look at that picture, that could be any city, manufacturing campus, school, et cetera, that exist, where really anything that touches, conserves, or generates energy in an efficient or renewable fashion could be applicable here. And so we're going to try to cover off on more of the mechanics and the compliance features today. But as you're thinking about what may affect you, I would say this is broader than it's ever been. Next slide. And so if we also think about who can do these projects, it's really wide open. I think the key here is that all taxable, tax exempt, every form of entity that exists, to the extent they're looking to employ an energy project, has the opportunity. In this IRA legislation, there's a direct pay provision, which means for all those tax exempt people who do not pay taxes, they in fact can get a direct payment back, similar to how the 1603 grant used to work in lieu of the tax credit. Also, if you are a taxable entity, you're going to be in a position where you can carry that back or forward. So you've got some pretty good certainty on your ability to consume the credit. And if you can't consume the credit, if you're a NewCo, you've got the ability to transfer and sell it to an unrelated party. So I think what's really great about the current IRA mechanics is it allows good projects to get done. It allows the benefit of the credit to flow to whom can use it. And ultimately, it allows projects that otherwise would have maybe been stranded more situationally to move forward.
When you think about what the credit can be worth to you and your organization, it's important to understand the framework of the IRA tax credits. And we're going to talk a little bit now about the framework that's used to calculate and understand the value of the investment tax credit and the production tax credit. The Inflation Reduction Act established a new paradigm and a new structure to think about credits on renewable energy and clean energy projects. There's this notion of a base credit and a bonus credit. And the idea is that you get a base credit by building an energy project that is an eligible property type. You'll see some examples of the property types in the upper right-hand corner of the slide. Things that you would expect, like solar, wind, hydroelectric, geothermal, combined heat and power. These are all eligible properties. And just by implementing one of those projects, you automatically get the base credit of 6%. But the Inflation Reduction Act had a lot of goals beyond just expanding clean energy as part of the act. There was a real focus on trying to boost clean energy jobs, boost domestic manufacturing, and bring investment into communities that traditionally have a lot of oil, gas, and coal, who as the energy economy begins to transition to cleaner energy sources, those communities stand to potentially lose business and lose economic activity in those areas. So there was a recognition that they wanted to provide extra incentive in those communities. So with all those goals in mind, the ITC is calculated first as a base credit, but then they brought the federal prevailing wage and apprenticeship requirements, which are common in federal construction projects, into this credit regime. So if a project follows and bids projects using prevailing wage and apprenticeship in their labor costs, you get a 5 times multiple on the base credit. They're giving you a very large incentive to pay prevailing wages for these projects. And so a 6% credit becomes a 30% credit if you meet the prevailing wage and apprenticeship requirement. Then there are additional bonuses, some of which are in your control and some are not in your control. One that's in your control is the domestic content bonus. This is, as I said, a focused bonus to try to boost domestic manufacturing. And so if a project chooses to source its steel and iron and to source its manufactured product components above the required threshold to meet domestic content requirement, you get an additional 10% bonus on your project. In addition, if you locate your energy project in a designated energy community, which we'll talk about in more detail, but it's a community that traditionally has a lot of oil, gas, and coal production in that area, you get, just by the location, you get an additional 10% by being in that community. And finally, specifically for solar and wind projects, there's an additional potential benefit of a 10 to 20% bonus if you're in an environmental justice or low-income community. These are communities that are specifically targeted for additional investment, and this only applies to solar and wind projects. This also is a competitive bonus, while the other ones are an entitlement program. So there's a little bit more complexity in earning that bonus. And finally, there's a recognition that if you use tax-exempt financing for a project, the federal government sees that as double dipping in federal incentives. So this is important for our municipal clients or nonprofit clients who may be taking advantage of economic development incentives and bonds. If those funds are used for this project, there is a deduction of 15% of the credit amount. You can go to the next slide. Similarly, for production tax credits, which are credits that are earned on a per unit basis for clean energy that's produced. This is done for solar and wind, for example, and for a number of other property types that are listed in the upper right-hand side. It follows the same framework. There's a base credit. There's just per kilowatt hour just for implementing those property types, and then there is a 5 times multiple for prevailing wage and an additional 10% for domestic content and energy community. You can go to the next slide. Understanding the 5 times multiplier is obviously of a lot of interest to many companies and many entities, because the real opportunity to maximize your credit comes with being able to take advantage of that 5 times multiplier. And in order to meet the 5 times multiplier requirement, there are a few ways to get there. As I said before, the goal of legislation was to boost clean energy job wages. And so for projects that are seeking the full credit, you'll want to understand and include in your bid package the requirement for labor to be paid following the federal prevailing wage and this new apprenticeship program. This is a requirement across the board, but there are a few exceptions. The first is a recognition that some projects, when the law was passed last year, were already in construction. So if your project has begun construction prior to January 29th, 2023, then your project may be exempt from the prevailing wage and apprenticeship requirement and still earn the full 5 times multiplier or 30% credit. In addition, if a project that generates electricity is less than 1 megawatt AC, so this is for small projects, there's a recognition that those small projects are small enough to not require this requirement, and so they're exempt too from the prevailing wage and apprenticeship requirement and can earn the full 5 times multiplier credit. It's always helpful to look at an example. So here's just a simple example. Consider a $10 million utility scale solar project, for example. The value of the ITC can be pretty significant and can affect the payback period and the IRR on a project quite significantly. So in an example, if you had a $10 million energy project, of which $8 million is eligible energy property, and the reason it might not be the full 10 million is that certain costs are not always eligible for the investment tax credit. For example, demolition of a site is not generally eligible as an ITC cost. So there is an exercise of segregating out costs as to what is eligible, what is not. So in this example, assuming $8 million are eligible energy property, from the outset, you'd be eligible for a 6% base credit or $480,000 towards your project. But then if you followed the prevailing wage and apprenticeship requirements and met those requirements, you'd be eligible for 5 times 6% or $2.4 million on that $10 million project. In addition, if you chose to source the components of that project from domestic manufacturers that meet the minimum threshold, you'd be eligible for an additional 10% or an additional $800,000 on this project. And if your project happened to be in an energy community, for example, in a place like Pittsburgh or Charleston, West Virginia, which are energy communities, you would be eligible for an additional 10%. So there's a total credit potential here for $4 million, depending on the facts and circumstances of a project, which can be pretty significant. And as a result, it can bring down your total cost of the project through this credit. The credit can be applied directly against federal taxes owed, or they can be sold to an unrelated party as a transfer and sale. This is a new feature from the Inflation Reduction Act, where you can now sell and transfer tax credits from one entity to another if the earner can't monetize those credits immediately. As well as for tax exempt entities, you can file for what's called a direct pay credit and actually have that credit come back to you in the form of a direct payment from the Treasury.
Thanks, Gideon. And I think that's a good segue. If you look to the prior slide on that delta, as I was taking some notes, you're really talking about the difference in that example of a $480,000 credit back to you or a $4 million credit. And that's why what the rest of we're going to talk about is so important. The delta between the minimum amount of credit in this new paradigm with IRA and what is possible is a very broad gap, and again drives a lot of why the rest of this, while very nuanced, very much kind of living, breathing, and dynamic, is critically important, and why we're really gearing up and have geared up to help folks deal with all these issues. So let's talk about, again, what's new, what's changed, what is yet to change or be clarified. The guidance has been issued around definition of energy property, what qualifies, that sort of thing. The begun construction rules, or what we call the safe harbor rules, the constructs of those haven't really changed with the IRA, and they've been in place for a long time, going back to that 1603 grant period, for those of you that remember that. Energy community guidance has been issued, domestic content guidance has been issued, and the regulations for prevailing wage and apprenticeship have also been issued. And again, these are all the important things that go into, in that prior example, getting from $480,000 of value back to $4 million of value. And in most cases, that could make or break your project. So let's talk about guidance that's pending. The actual registration mechanics around direct pay, additional guidance around transferability that Corey spoke to earlier. There's a manufacturing credit for manufacturers of components that go into the energy transition universe here. One round has been initiated. There's a second round to come, and there's a full application process for that round yet to come. That's a $10 billion bucket of manufacturing, a tax credit specific to manufacturers. Further guidance has yet to come out. And of course, the final guidance on the most critical of all these kind of bonus adders, the 5 times prevailing wage and apprentice, has yet to be seen. And I think the overarching comment here, before we get into our first polling question, really is these regs, and more so the guidance, based on our experience ever since the first energy tax credit evolved or came about always are changing, always are being modified. And it's really our job to be on top of that all day, every day, to kind of help our clients sort through decisions you're making, the best decisions you can possibly make, the most risk-averse decisions you can possibly make, with the guidance and regulations that are available at the time you're making those decisions. That's really the best way to think about it. So note that this is all fluid. It's going to continue to be fluid for some time, even though we're well over a year since the Inflation Reduction Act was signed. We're getting more and more clarity by the day, developing more and more solutions around this guidance by the day, but know that it's going to continue to evolve. And with that, we'll go to our first polling question. And the question is, how much has your organization discussed the IRA so far? A lot, a bit. We've heard about it, but would like to learn more. And I would say, as you're answering the question, even a year plus out, we're definitely seeing a continued population of folks in all three of those buckets. So if this is all brand new to you and you feel like we're going through too much in too short a period, you're not alone, for one, and there's a lot more information available. And there is, goes without saying, as legislation stands, about a 10-year runway, plus or minus at a minimum, with the legislation as it currently sits. So you're definitely not too late to the party. Corey?
Thanks, Joel. So I'm going to cover off on some of these compliance requirements, and just seeing some of the questions come through the chat. One thing to be aware of is, there's a base energy credit, there's these bonus criteria, and you have to comply in order to earn it. Otherwise, it can't be substantiated. And the way and the person that substantiates, that credit is the tax repair. So that the credit is earned by the owner when the project is placed in service. So whoever that owner's tax repair is ultimately who will be saying to contractors and vendors, hey, show me that you met any of these criteria, so that we can substantiate it and claim it. Because under Section 6001 of this guidance, it is very clear that if you didn't substantiate the credit throughout, you wouldn't have the ability to at the end, and you couldn't actually claim the credit. And so I want to just stress today that there's a lot of questions around who gets the credit and how do you apply for it. Most of these are entitlements. It's filed on your tax returns. So it's really your tax repair is the burden of proof. And we're going to talk today about how you and your tax preparer can be in sync so that they're getting the necessary information when they go to file this credit. Next slide. Next slide. So I'm going to cover off quickly on prevailing wage. Go back one. I think the main message here is that many contractors, many owners, many municipalities have dealt with prevailing wage. Prevailing wage is, we'll say, as old as dirt, right? It's been around a long time. But what's different is prevailing wage and apprenticeship for IRA is unique to itself. And so, as we hear people say, I've asked my contractor to do that, as we hear the contractor say, no, I've got that covered, I've done that before. Then when we meet with the contractor and say, show us how, they start to say, I didn't realize there was all of these qualifiers in order to satisfy the requirements of IRA. And so, effectively think of this: all laborers, mechanics employed by every contractor or subcontractor are subject to this requirement during construction, alteration, or repair. So I think of this as like capitalized things, not routine maintenance, on a go-forward basis during the life of the credit. Next slide. And so, as we talked to folks, the Inflation Reduction Act is its own tax law. Davis-Bacon is a labor law. IRA uses Davis-Bacon as a framework, but the IRA is not a related act. So the Davis-Bacon side only provides a framework, not the rules and regulations to substantiate how the IRA tax credit will be earned. And again, that's that burden of proof with your tax repair. Next slide. And so as we talk about, the duration that people are going to be subject to this, is generally 5 to 10 years. So if it's an investment tax credit, it's construction plus 5 years during recapture. If it's production tax credits, most of those have a window of 10 years. And so, this is something that's got to keep good books and records throughout. again, in order to either earn it upfront during construction or not jeopardize it as you go forward with recapture. And recapture is effectively having to give the credit back if you didn't actually substantiate the credit in the first place under audit. And so a little bit about what those qualifiers are, that are unique to IRA. First, just basic, contractor pays wage, not less than prevailing wage rates for construction, alteration, or repair during that period, and maintains good records. Or if they don't do that, effectively they've got the ability to make the worker whole with penalties. And they've got a cure period to do that, and if they don't, they're going to incur $5,000 per worker. So in some of the contractors or people say, hey, we've got it covered, or the owner's saying that their contractor has it covered. If they don't, and if they don't cure it within very narrow windows of time throughout the project, quickly the penalties add up to be probably greater than the value of the credit. And further, if we've had some say, I don't want to deal with it, or I haven't dealt with that before. Hopefully, it kind of goes away, or subsequent guidance, right, makes this easier. Right now, if you don't deal with it, there's intentional disregard. You're going to pay a penalty of $10,000 per underpaid worker per year, plus 3x of the sum of unpaid wages plus interest. And so it quickly says, if you want the bonus, you need to substantiate it and go after it. And if you don't, the penalties incurred will likely exceed that of the bonus criteria. Next slide. So a bit about what this means overall from a planning perspective. The prevailing wage rates are locked in at the start of construction. And so in most cases, you're looking at your area, you're determining what prevailing wages are. You're making those wage determinations, at the start. And before things start, 90 days before, because if you don't have a given wage classification, you'd be requesting one from Department of Labor. And when you get one back, you've got this 30-day period to cure. And so active management throughout is very important, because when you do misstep or mispay, you do have the ability to cure. But if you don't, that's how you've incurred those penalties. Next slide. So, as we look then at, the correction or back payment, effectively, you're going to have your contractor doing work. You're going to have your contractor reporting, likely to the tax repair saying, yes, we're complying throughout. That tax repair is going to be going to the owner saying, okay, based on this month's progress, on October's progress, we're going to meet on November 15th. We've become aware that a few of these need to be cured. You have 30 days to cure them. If you don't, you're going to incur these penalties. And that's going to be continuous throughout the project. That helps the tax repair substantiate the credit. It also helps the owner avoid penalties. In addition, then, to the prevailing wage requirement, having the ability for those penalties to be waived. It's that, and either if the mechanic's been paid below that, labor or mechanic has been paid below that prevailing wage for not more than 10% of all pay periods of a calendar year, or the difference between the amount the labor mechanic was paid for the calendar year is not greater than 2.5% of the amount required under the prevailing wage. And so, this was something that came out in the second bit of regs. The initial law stated what prevailing wage was. It didn't say how to comply. In August 30th, September 1, those new regs came out. We're still waiting on the final guidance, as Joel mentioned earlier, but effectively they're trying to say if you see something and the tax payer, the owner, becomes aware, the person earning the credit becomes aware, they have to cure it. A little bit about wage determinations. Wage determinations are effectively based on location, category, and date. So there's going to be a lot of projects in rural areas. It's likely that there may not be an existing Boilermaker classification if there hasn't been a project there before, at which point you have to request a wage determination from DOL. Wait, up to 90 days to get that back, and then you'd have 30 days to cure. You're also going to have to delineate between the building, residential, highway, or heavy classifications so that you are in fact paying the right prevailing wage. And again, this is all at the date with the contract starts with the prime contractor. Next slide. So you can see it is prevailing wage like, but there are additional qualifiers. And because of these time elements with penalties and the need to cure, it's critical that the certified payroll is continuously throughout and that there's a way to project and monitor it. Next slide. Getting in a bit to the apprenticeship side. Apprenticeship is really the net new piece here, and apprenticeship now in the second round of regs, said of the total hours for construction that say began before 2023 here, or during 2023, before the end of this year, let's say 12.5% of those total hours of the project must have a apprenticeship. And the good news is it initially started out as per contractor. There'd have to be this pro rata split, but it now says all those hours can be all those hours can effectively be earned through any one contractor. So you could have one of 8 contractors meet this requirement for you to hit the 12.5%. The others have to still participate if they have 4 or more. So they might have to minimally keep people in an apprenticeship role, but it does allow some flexibility, acknowledging, some large trade organizations might have their own apprenticeship programs. It might be an easy hurdle. Others might not. And so as you look at that, there is some additional flexibility. Also, there's a ratio requirement. Taxpayers, contractors, subcontractors employ 4 or more to perform the work, must employ 1 or more apprenticeship. And again, non-compliance if you don't. Next slide. So for the apprenticeship compliance side, again, we've talked about, I'd say the table stakes here with the hours, participation, and ratios. If the contractor can't do those things and makes good faith efforts to satisfy apprenticeship requirements, they can do so by saying, look, I want an apprenticeship. I applied for one. I did that every 120 days. I couldn't get one. They have to document their proof of denial or non-response within 5 business days of that request. Otherwise, they'd be subject to paying a penalty of $50 per hour for any unmet apprenticeship hours. So again, perfection won't occur. Every geography is going to have more or less available, but continuous intent to get and put in place and documenting that is required. And back to the intentional disregard, if you just proceed without this, or you've already started and haven't been measuring it, there'll be a penalty to Treasury of $500 per hour for any unmet apprenticeship hours. So if you would prefer not to use apprenticeship but take the bonus criteria, it would be unsubstantiated as a tax credit goes, and it's again likely that the sum of those 2 penalties would negate the benefit of the bonus. So it goes without saying, again, it's the record keeping is critical. The tax repair can't really substantiate the credit without it. Next slide. So in total, we have 3 pillars of compliance for PWA are in need. Is it starts with what is known as prevailing wage and certified payrolls. We're expecting those certified payrolls to pass through a process that then computes, those ratios, both at a vendor level as well as a project level to make sure you're in compliance. And if perfection doesn't occur, somebody misses something, it needs to actually measure the penalties incurred, because as we go to file this bonus criteria for you, it'll be prevailing wage, apprenticeship, penalties, right? And if those 3 things have been satisfied, the credit's been earned. Next slide. So really just a little bit to think about, before construction begins, if at all possible, establish a plan, educate your contractors. Next, implement a certified payroll tracking system, something that you can log and timestamp all these. We are currently partnered with a group called LCP Tracker. They're a well-respected entity, been around a few decades in the public works projects, and we have built a compliance program on top of that software alongside of it so that we can be in sync and have the ability to help our clients manage this during, throughout, and at the end when we go to prepare for that filing of the tax credit. Next slide. With that, I'll pass it over to Joel to get into some of the domestic content compliance requirements.
Thank you, Corey. And before I do that, if we could just, I think we're doing pretty good on time. I wanted to take a look from, if I'm sitting in the audience right now, and if you can speak to the experience you've had, Corey, in working through this in spades. As we all know here internally, the market, if I'm an applicant or I'm a project sponsor, and I see all this and I'm like, man, this is really confusing. It seems like a lot. Hey, contractor, you guys deal with all this. That's really not the approach to take if I'm thinking about it correctly. And that ultimately, as a sponsor, I'm the applicant for the credit. And regardless of what's in my contract with my EPC or however I'm building the project, that sounds like a big mess if they're not compliant and I put everything on them. So where are you finding the balance between sponsor obligations versus contractor obligations, and how folks are looking to navigate or asking us how they should navigate that?
No, great question. Because I mean, traditionally, hey, this project's subject to prevailing wage. Hey, contractor says they can do it. It's covered. Contractor thinks they have it covered, and traditionally has, right? Again, this is unique to IRA and claiming this bonus credit only. And so, in talking with contractors and peeling back the onion with even ones we know well with our good clients of ours, as we sat them down and type in front of this type of detail and said, how would you administer this? They said, we really had no idea that that's what was meant by that, because the word was in the bid docs, even from the owner of the project. Can you meet prevailing wage? And this is a prevailing wage and apprenticeship requirement for IRA, which is, the unique part. So I think the awareness we've had with some of our contractors is to say, can we help you speak to the owner, who's ultimately going to have their tax repair apparatus, have them understand that the contractor can meet prevailing wage requirements, and that is separate from meeting prevailing wage and apprenticeship. And so in order to comply with that, you need a program, you need a compliance management program to augment that and ultimately enable the tax repair. We've also encouraged many contractors to not just talk to the owner, but the owner's tax repairer to say, are you in sync with them? Have you really talked about what you're going to need to give them and when? Because I think as these penalties and this new guidance came out, it was clear you can't start late on this, and you can't start at the end. It's possible that tax repair would be uncomfortable, being able to substantiate that credit. I keep using the word substantiate and tax repair, but what it comes down to is that tax repair has a professional standard. They have to be able to substantiate it. If they don't, they can't claim it. It says so. And if it's unable to, if they did submit a tax credit that was unsubstantiated, they'll not only lose the credit under audit, they'll incur penalties and significant penalties. So I think contractors should talk with owners. I think owners should be aware of what they're asking their contractors to do. I think the right language should end up in the bid docs to those contractors, so that contractors, know what the owner is expecting from them, and ultimately, document as soon as possible, each hour, because it is every hour counts, and these cure periods are all short 30-day windows.
Very, very helpful and makes sense when you slow down and think about it a bit. So thank you for that. With that, we'll transition to an additional bonus opportunity, not quite as substantial as the impact of meeting prevailing wage and apprenticeship, but substantial nonetheless, and the opportunity of an additional 10%, going back to Gideon's kind of ITC buildup. Meeting domestic content can get you from that 30% if you've met prevailing wage and apprenticeship to a 40% credit, which is substantial and never been available before through the history of energy tax credits in the United States. So this was kind of, again, along the lines of a carrot and stick kind of program by the Biden administration, where if you meet this requirement, you're getting a 10% bonus. Now, what is this requirement in a nutshell? And we're going to go through this really, really quick. I should note that there's a dedicated domestic content team within Baker Tilly. We've got a lot of information on our IRA Resource Center, presentations specifically to domestic content that are, 20, 25, 30 slides in length. So I'd point you to there if you're looking to dig into this a little deeper. But at a high level, the domestic content requirement is that steel and iron in a given project must be 100% produced in the United States. That is a pass-fail, black and white, absolute. 100% structural steel and iron. Manufactured products, it's a little more nuanced in that it's 40% of the total manufactured products, at least as we sit here today. That percentage, as you might imagine, with the idea that more and more manufacturing facilities are going to be developed in the United States or onshored and moved back to the United States, increases up to a percentage of 55% after 2026. So kind of a sliding scale, but those are the two key tenets in the domestic content bonus to be aware of. One is an absolute, one is a calculation. Next slide. So when we talk about structural steel, I'm not an engineer, I'm not a construction guy. You can think about structural steel as something that's creating load-bearing elements of a structure. So beams and columns. I think the pictorial graphic, if you look to the left, that's what a layperson would think of as structural steel. Manufactured steel might be more of a skid when we think about combined heat and power units or biogas equipment or things of that nature that are more plug and play. That's more manufactured steel. So structural is where, again, we've got to worry about this black and white 100% pass-fail test. Manufactured steel, we've got a little more leeway. That's a critical designation. We get a lot of questions around that, and there are certain gray areas that we certainly don't have time to get into on this call, but have other collateral materials, presentations, and such that get into those nuances. But a key tenet. Next slide. In terms of sitting in a developer's shoes, what is the information to get started? What are you asking your vendors, your contractors? And again, on the manufactured side, fairly simple. Is it manufactured in the USA? If not, where? And building up a schedule of values around those costs. And on the structural steel or iron side, is the source material in the USA from the USA? And if not, where is it from? Getting that information in a transparent way, in a certified way from the various stakeholders, participants that you're dealing with on the vendor side, contractor side, et cetera, is paramount from a starting point. Next slide. In terms of bid specifications, and we work a lot with sponsors to kind of help integrate language into contracts. As you can imagine, the devil's always going to be in the details, but we've got a few bullets here, I think, for your benefit at a base level from a bid specification perspective, what one would expect. And I don't need to read all of those off. You can kind of see them on the screen. I think it makes sense in terms of what you would typically require to certify or provide an affidavit of country of origin related to manufactured product, and correspondingly the whole 100% test on the structural steel. Next slide. Again, country of origin identification. The middle bullet there, manufactured cost, is a good point, because you might be saying to yourself, well, whoever's selling me the combined widget that I'm buying will have a price, and that'll be the price for how I do this calculation. The critical number is the manufactured cost. So when you're talking about a piece of equipment that has 10 different widgets that come together and make a product, someone understanding, whether it be the customer, which is somewhat unlikely, or an independent third party that will certify what that manufacturer's cost is as it goes into that computation, is absolutely critical. And then, of course, signed statements under penalty of perjury that the information is accurate. So, those are all critical. Wanted to step to a specific nuance in the regulations, in the legislation, relative to elective pay taxpayers. So all you higher education institutions, tribal governments, state and local governments, not-for-profits. There is a stick element to domestic content, and when we think about the carrot and stick, that applies a haircut to your eligibility for even your base credit. So going back to that 30%, you have a higher threshold to meet domestic content than a non-direct pay or non-elective pay entity. So relative to this construct of begun construction, which I'll talk about a very, very little bit after this slide, if you do not meet begun construction in 2023, your eligibility, and subsequently do not meet that domestic content requirement, your eligibility for your base credit goes down by a factor of 10% in 2024, 15% in 2025, and then there's an absolute cliff in 2026, where if you hadn't met begun construction by that date and do not comply with domestic content, you are not eligible for direct payment. So the federal government, in its call it infinite wisdom, call it a view to pushing more and more onshoring of domestic manufacturing, put this provision in specific to direct pay recipients. And in a lot of our conversations with stakeholders, clients, this is getting lost a little bit in all the information that's out there. So this is absolutely critical to understand. If you are contemplating projects and don't understand it, you should be having conversations with folks like us and your advisors yesterday to really understand what that means. So let's get into a little bit about what begun construction means and how, for those types of entities, in the next 2 months, you might be able to provide a more of a belts and suspenders approach to maximize your credit amount. The begun construction concept really is rooted back within the tax code and guidance that came out around, again, the 1603 grant period, and it's been used in a lot of different ways as credits have ebbed, flowed, began to sunset, been reintegrated, et cetera, et cetera. But really what it is at its core is there's a test that needs to be met. One test is called the physical work of a significant nature test. A second test is called the 5% safe harbor. One test, the physical work test, involves what it's described as physical work starting on a particular project site, or in our experience, more common, maybe at a manufacturing facility or offsite where a PO is made for certain property that's eligible within the overall constructs of the project. A physical work, that product, that PO that the product is under, manufacturing starts on it within a given construct, and then you have a fairly broad leeway into when ultimately your project is placed into service once you've met that construct. The other more binary black and white is incurring 5% of the overall project cost, and for a lot of taxpayers, taking title to that within 3.5 months of incurring that 5%. So these are tests. These need to be met actually prior to the end of the year. The slide is dating back to the test as it related to prevailing wage and apprenticeship, but the test for the purposes of domestic content needs to be met by 12/31/23. And again, the overall takeaway, we could talk for 30 minutes on begun construction. It's not as hard to me as you may be thinking. It's doable, but you need to start having the conversation now if you don't believe your project, or there's any question about your project meeting the domestic content test. With that, I'm going to turn it over to Gideon, and he's going to talk a bit about energy communities.
Thank you, Joel. Another opportunity to expand and bolster the credit for a project is the energy community bonus. The Biden administration and Congress in general made an important bonus criteria here for communities that are longstanding energy producers and that stand to have to weather the energy transition toward clean energy in a different way, perhaps, than the rest of the country. It's a recognition that communities that traditionally produce a lot of oil, gas, and coal, and have a lot of, for example, coal-fired generators, coal-fired power plants. These are important facilities and job creators in those communities. And as the energy system transitions over time to cleaner resources, jobs will be affected in those communities. And policymakers recognize that these communities really need extra incentive to have new, cleaner energy facilities come to their community. So the energy community bonus is a location-based bonus. It is not in your control. If your project happens to be in an eligible census tract or an eligible municipal area, then you get this bonus. If you're not, you don't. And there are some specific criteria that need to be checked and met in order to see whether you can qualify. You can go to the next slide. There are 3 ways to figure out whether you are located in an energy community. One is very, very parcel and site specific, and the other 2 are regional. I'll go through each of them briefly here. The first way to be considered as a site in an energy community is a recognition that there are many sites throughout the country that have environmental contamination. Often it's a result of historical industrial activity on the property. And this is an area this is a category of sites that are well understood under federal law. And there is a recognition that these are sites that they'd like more investment into. A good example would be, building a solar facility on top of an old landfill or on top of an old contaminated industrial site. So if a site is considered a brownfield, and a brownfield is defined specifically for the IRA, so it's a different definition than the general federal definition of brownfield. It's a site that has either evidence of contamination or potential contamination by hazardous materials, pollutants, contaminants, and is also not in a specific set of federal categories. Any parcel that meets that category can be considered a brownfield. So this is an opportunity regardless of what census tract or location you're in. If you're building an energy project on a site that has potential contamination, that has had a phase 1 or a phase 2 environmental report done on the property, which is common when properties change hands, and there's evidence of potential contamination, this is something that you may be eligible to capture as part of the project. And we've helped a lot of clients better understand whether a site might be eligible through the brownfield category. The second qualifier is if you're in a municipal statistical area that has a lot of oil, gas, and coal related employment or tax revenue. Again, this is a recognition that assets like mines and coal-fired power plants and oil and gas assets, they contribute a lot to a community. They employ a lot of people, and they also can sometimes generate a lot of tax revenue for a locality. So there are specific tests that if a municipal statistical area, meaning a city, a town, a rural area, has a higher than average level of employment from the extraction, transportation, or processing of oil, gas, and coal, and they have an unemployment rate higher than the national average, they become qualified under this category. And so then they are eligible for this bonus. Finally, if you're in what's called the coal closure category, this is a specific category that's defined to help coal impacted communities. Many parts of the country, over 40 states, have coal mines, and many regions have coal mines that employ a lot of people. And there's been a tremendous amount of closed coal mines and closed coal-fired power plants over the last 20 years as things begin to transition and the market begins to transition toward cleaner energy. So if you're in a community or specifically in a census tract or an adjacent census tract to a closed coal mine or a closed coal-fired power plant, that location can also be eligible for the energy community bonus. These reviews of understanding whether your community qualifies can be complex. So if you go to the next slide, Baker Tilly was proactive in this in understanding this category of bonus, and we've created an energy community mapping tool, which you can find on our website. And you'll see in this mapping tool an ability to type in an address or a city and town, and you can see where your community falls in the energy community mapping. What you see here is just a screenshot of the whole country from the mapping tool. The green areas are certainly eligible for the energy community bonus, and the gray areas might be eligible for the energy community bonus and need further investigation. And that's because the gray areas are areas where the unemployment rate is higher than the national average, but we need to do further investigation to see whether the tax revenue in that region may meet the threshold for energy-related tax revenue. So it's a useful tool. You can feel free to use it on our website, and I think it's something a lot of companies have found useful. We'll go to our next polling question here. So as we continue to go, please answer the polling question. And I'm going to quickly go through two examples, and then we're going to talk about some questions. These are just two examples to think about as you think about common projects. This is just an example of how the IRA incentives can affect a distributed solar generation example. This is for a 1 megawatt solar project, estimated cost of $1.5 million. And this is just meant to show how in a region where power prices are high, and also a region where you have an opportunity for significant ITC amounts. So if you both get the 30% bonus, you may also be an energy community that brings you to 40%. You may also get the domestic content bonus that brings you to 50%. And if you're in, for example, a tribal area, it can push as high as 60 or 70%. You can see that the payback period can really be impacted. You can go on the low end from a payback period in this example of 14 years to as low as 3 or 4 years if you qualify for the ITC at the maximum amount. So it just gives you a sense of how impactful the ITC can be. You can go to the next slide. Another good example is thinking about campus energy systems. The IRA really does have a lot of opportunities for campus energy systems. Combined heat and power is the only technology, the only fossil fuel technology that is included as a clean energy resource under the law. And many campuses, whether it's university campuses, hospital campuses, use central utility plants as part of their infrastructure. And this is a real rare opportunity to do major deferred maintenance on some of those facilities, because these are often facilities that unfortunately have been neglected over the years. But the IRA increased the tax credit, for example, on combined heat and power property from 10% to 30%, assuming you meet the prevailing wage and apprenticeship. So there's a lot of money for these types of facilities if you meet the requirements. There's also additional categories of eligible property like microgrid controllers, which had not previously been part of the incentive system. So as microgrids become more popular, this is something that can be very beneficial to campus systems. You can go to the next slide. We have one more polling question for you, and then I think we're probably ready to transition to some Q&A if there's time. Corey?
Thanks, Gideon. So I just want to say that, throughout this, act that has been passed, there's an awful lot of qualifiers that are in place. We, our accounting, tax, and advisory firm, and with that, we've helped clients set up projects, the business case, help them substantiate and comply, help, contractors throughout the construction process. And ultimately, our single goal is to allow that tax owner to file for that tax credit, and in doing so, know that they have substantiated it. And then for those that have a credit they can't use, Baker Tilly Capital has the capabilities to bring that to market and sell it. And so I just want to say that it's not a light effort. We have a full-time team of just tax people interpreting the guidance that comes out to help us as service providers here understand what we have to do to stay in bounds. And so for any of you trying to learn this and keep up with it, we'll just say that some of the comments Joel made earlier is that it's a continuum. This is going to be around for 10 years. Guidance is going to come out. FAQs are going to come out. And so I would just encourage you to stay current, or convene with your own consultants or tax advisors, because things do change with each turn of guidance coming out. With that, we've got, looks like a couple minutes left over for Q&A. I can start with one here. There was a question around, effectively, if a contractor requests an apprentice and there's not one available, do they still have to pay a penalty? And it's a good question. No, there's a good faith exemption there. You effectively go request one. If there isn't one available, you document that you either didn't get a response, the date you requested, no response, or the denial. And at that point, you've got 120 days where you don't have to apply for again. If you remain on that project, you do have to, at the end of that 120 days, reapply, because there will be quite a few geographies that maybe energy projects are going into that the apprenticeship programs are not built up yet, and as a result, they're going to have to take advantage of that good faith exemption.
Great. I'll address one that I think I was hoping to address at the end. And if I were sitting in the audience shoes and gone through a whole bunch of information, complex information in an hour, would be asking the same thing. And that's, is there a minimum amount or economically feasible amount to justify the costs associated with applying for the credits? This is compliance heavy. There are no ifs, ands, or buts about it. But I would say two things is I referenced earlier Gideon's example of the $10 million project where compliance led you to a $4 million benefit. Lack of compliance got you $480,000. Couple things. there are exemptions on the prevailing wage for projects less than a megawatt. So again, if you're, think of a megawatt project, whether it be wind, solar, maybe some other technologies, you're probably north of $1 million in terms of total project cost in a lot of cases or most cases. So if you're below that threshold, you don't have to comply with the single, probably most challenging thing to apply in a lot of cases is prevailing wage and apprenticeship. Also, something to note, which gets lost on a lot of developers, is many of the soft costs associated with these projects, including costs related to your compliance program, whether you do it in-house, if you're tracking your time and effort associated with that, or outsource it, are actually eligible if you capitalize them within the constructs of the overall capital cost. So at the end of all this, our cost segregation team takes all the project costs, hard costs, soft costs, direct costs, indirect costs, eligible costs, ineligible costs, and looks to maximize what's called the eligible basis to claim your credit on. So long way of saying that dollar you may spend on internal time or external time to comply with the rules and maximize your credit will benefit from the actual credit you're seeking to pursue by being part of that overall calculation. So in a sense, you'll get some of that back via your tax credit. So wanted to make sure that was addressed. And I know we're about at time. I don't know if there's any other questions, Gideon or Corey, you'd like to try to take a stab at before we wrap up?
I think we've covered a lot today. I know it's a lot of information to digest. So as you do that, feel free to reach out to either one of all three of us. Our contact information is here, and we'd be happy to talk to you about it more. It is a lot to process, and as Corey said, there's probably at least 30 or 40 minutes to talk about each of the topics we covered today. So we're happy to do it, and hope you've enjoyed the webinar today.